The Reserve Bank is under pressure to set out a timetable for interest rate hikes. A flood of homes hit the market, and how Elon Musk lost over $50 billion in 4 weeks. It's Monday, the 31st of January, 2022. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Michael Thompson, and good morning, Sean Aylmer.
Hello, Michael.
Sean, before we get to business, putting all that to one side for a moment, how good was the tennis on Saturday night?
Fantastic. How can you not be an Ash Barty fan? 1-5 down to come and win in 2 sets, 7-5 in the second. Fantastic. As Ash Barty said, it's great to be an Aussie.
I thought it was just a really, really terrific moment. And I thought we just had to start off with that this morning because it was just an absolute highlight of the year, and it's only January.
Absolutely.
All right. Now, remember, stay listening straight after the show for Sean's chat to Elise Kennedy, Vice President of Equities at Jarden Australia, about buying opportunities in the tech sector. But first, Sean, as I mentioned, all eyes are on the Reserve Bank this week. Its board meets tomorrow, and there's a fair chance it's going to soften its stance on when the next rate rise will be.
That's right. Following the US Fed's decision to start lifting interest rates, the higher than expected inflation figures locally last week, and the strength in the jobs market, the central bank here is certainly under pressure to drop its insistence that rates won't rise until 2024. There are plenty of economists out there who now think the Reserve Bank will make that change tomorrow. The argument against such a change is along the lines that the Reserve Bank has consistently said it wanted to see wages growth of between 3 and 4% before it moves on rates. Now, while the unemployment rate has dropped to 4.2%, and anecdotally there are plenty of job shortages across the country, wages growth hasn't yet picked up. That's the real spanner in the works. But financial markets have already priced in 2 rate rises this year. The statement from the bank, due out at 2:30 p.m. tomorrow afternoon, is undoubtedly the most significant decision in several years. If the Reserve Bank does indicate it's looking to lift interest rates sooner than expected, that should trigger support for the Aussie dollar, which over the weekend slipped below 70 US cents. Now, it hit these levels briefly late last year, but otherwise it's at an 18-month low. Might not be so good for people wanting to travel overseas. We're allowed to do that now. But it is good for the Australian economy because our exports are cheaper. Many goods are priced in US dollars, and so the Aussie-US dollar exchange rate really matters to our economy. The key reason for the fall in the Aussie dollar really is the strength in the greenback. And that's because the Federal Reserve has signalled it will soon start lifting rates. And investors like to park their money in economies which offer higher interest rates, at least in the short term. Hence, the US dollar has appreciated against the Aussie dollar.
It is a really big week this week, and fortunately we've got some interesting interviews coming up that'll help to basically explain the significance of it all. But Sean, certainly all the debate around rates has hit equity markets. The ASX 200 fell for much of the week, but there was a bit of a turnaround on Friday.
Sure was. The S&P ASX 200 finished up an impressive 2.2% on Friday. Traders were buying the dips, looking for good companies that have been sold off. Kind of looking for bargains is how you can think about it. Great companies like Goodman Group, Wesfarmers and Macquarie Group, all stocks that have been sold down recently were up more than 4%. REA, Xero and Coles jumped more than 5%. CSL, Woolies, Rio Tinto, Transurban, great companies. They all jumped more than 3% last Friday. Now, the index closed at 6,988 points. That's still relatively low. Notwithstanding the dramatic sell-off in recent weeks, remember the bourse moved into correction territory last Thursday, it's actually up 5% over the past year, which is nothing like the numbers we were talking about just a few months ago. It's worth pointing out the performance of BHP in recent sessions though, Michael. Its share price is up 11% so far this year, much, much better than the market, including a near 3% jump on Friday. Iron ore prices are rising. That helps a lot. The spot price is up 24% this year, and some analysts think it could reach $150 a tonne. Remember, it was back down to about $90 a tonne late last year. More generally, commodity markets are fairly robust. That's because the Chinese government is cutting interest rates in an effort to stimulate the world's second largest economy. That's helping all our miners. But in BHP's case, there's a little more going on. Now that its primary listing has moved to Australia, it used to be shared between the UK and Australia, it's now coming back to Australia and should happen this week. It will be upweighted in the S&P ASX 200 from less than 7% of the index to close to 10%. And all those passive index funds who just track the market, they have to buy BHP shares to match that upweighting towards that 10%. That's why BHP's done so well.
All right. And just before we move on from equities, what about Wall Street? How did equities respond to the Fed's decision last week?
Well, all three major indices rallied over the weekend, in large part thanks to Apple. The world's biggest company released its quarterly earnings, saying phone sales were up sharply over Christmas, particularly in China. In fact, total revenue for Apple hit a new record last quarter. Its share price jumped 7%, though it's still below where it started this year. The good news boosted other tech stocks, with Alphabet, Amazon and Microsoft all up around 3%. And Michael, generally European markets, they didn't follow the trend and they were actually lower over the weekend.
Okay, we'll be back in a moment with the rest of the day's business news. Okay, Sean, plenty to talk about today, and I love talking about property. There were a huge number of homes going to auction over the weekend.
Yep, sure was, Michael. FOMO, fear of missing out, is alive and well in the Australian property market. A record 1,160 homes went for sale in the last week of January. It looks like sellers are trying to catch the tailwind of the booming sector before higher interest rates cull the market. Now, the preliminary clearance rate down the East Coast was strong, according to CoreLogic, at around 74%, though that is weaker, of course, than a year earlier. Adelaide reported the strongest clearance rates at almost 84%. Canberra and Brisbane both were above 80%, Sydney was at 71% and Melbourne at 68%. It's going to be really interesting to see how the housing market plays out over the next few months. While many market economists still expect prices to rise this year, certainly the weight of numbers on the market will put downwards pressure on it.
Okay. Now, Deputy Prime Minister Barnaby Joyce says China needs to abandon sanctions on Australian exports so relations can return to normal. The comments came after the new Chinese ambassador to Australia actually said he wanted to thaw the frosty diplomatic relations between Canberra and Beijing. So it's a bit of an optimist, is he?
Well, he said the right things last Friday. Mr. Joyce was doing the media rounds yesterday, and while he welcomed the comments from the new ambassador, he said other factors such as China's military push into the South China Seas, the mystery surrounding tennis star Peng Shuai, and political interference in Hong Kong needed to be taken into consideration also. While Australia's exports to China actually rose last year, it was because of the price rise in commodities. They're expected to slow this year.
And it actually all comes as new research shows that the total value of Australian exports to China impacted by trade disputes is $23 billion.
It sounds like a lot, but it's just 4.5% of total exports. Given all the noise about the deteriorating relationship between Canberra and Beijing, I reckon that's not a bad result. The value of affected exports has been mild because most sectors have been able to find alternate buyers, according to AMP Capital Research. In fact, a bunch of products have found alternative markets and sales are now actually higher than 2019 levels, before the ban and tariffs were introduced by Beijing. For example, coal exports collapsed after last year's ban, but since the middle of 2021, exports to Japan and India have surged. Beef's another example. We're selling more to Korea and Japan. Korea and India have been buying more copper ore. Higher cotton exports have gone to Vietnam and Indonesia. Barley, wheat, sugar exports, they've all risen. However, wine, timber and lobster, exports of those products remain below 2019 levels. In aggregate, the Australian trade surplus has nearly doubled since mid-2019 to about $123 billion on an annual basis. The moral of this tale? The restrictions from Beijing have had a much lesser impact on the Australian trade balance and on the Australian economy than first feared.
That's really interesting, isn't it? So exporters have really had to kind of improvise after it all came in, and it's actually potentially leaving them stronger for the future because they're more diversified.
Absolutely. They've done a terrific job, and your point is what's so critical to all this, because Beijing have already started buying more coal from Australia, even though they banned it. They have bought some coal. As China comes back on board, demand for our products overall in aggregate will be greater, and that's really good for our exports.
Oh, great. All right. Now moving on, Sean, New South Wales is launching a $1 billion post-Omicron package to help businesses and landlords. That'll be welcome.
Sure will. Businesses will be able to receive lump sum payments of about 20% of weekly payrolls to cover the month of February under the package. Of course, these are the businesses in that state, New South Wales. Small business rebates will be expanded to allow employers to buy rapid antigen tests. Landlords who provided relief to commercial tenants will get up to $3,000 per month in grants if they waived at least half of the rent. It comes as New South Wales recorded its highest number of deaths, 52 yesterday. There were 13,500 positive cases also recorded. Now, state governments, particularly in New South Wales and Victoria, are trying really hard to help boost the recovery from Omicron, and relief to businesses is a really good way to do it. The New South Wales yesterday was just a touch critical of the feds of Canberra for not doing more. Outside New South Wales, Victoria reported 10,600 cases yesterday and 20 deaths. Authorities in that state said an Omicron sub-variant has been detected, which according to UK data is more contagious than the original Omicron variant. The variant has also been detected in New South Wales. Queensland reported 13 deaths yesterday and said all high school students in the state will have to wear masks.
Okay, well, we've talked a lot about supply chain issues as a result of COVID and border closures and really all the flow-on effects of that. Sleep disorder and breathing devices company ResMed thinks supply chain issues will diminish by the middle of the year.
Yes, and the company has gone to extreme lengths to handle freight challenges and find new suppliers. Now, ResMed really operates out of the US, but it's listed on the ASX here and is such a success story. But it's had to charter Boeing 787s and 777 passenger planes to fly products from Singapore to the US. That's how desperate it was. Revenue at ResMed was up 16% for the first half and profit was up 13%. The result was solid given ResMed had to recall devices in June last year due to risks around a foam component. CEO Mick Farrell said the company was struggling to keep up with demand in part because of greater adoption and awareness of breathing conditions on the back of the COVID-19 pandemic.
Okay, Sean, what's making headlines in today's news media?
Popular support for the federal coalition has fallen to the lowest level since the 2018 leadership spill, with Scott Morrison's approval rating also tumbling, according to the latest news poll in the Australian newspaper. Anthony Albanese is now just 2 points behind Mr Morrison as preferred Prime Minister. An election, of course, is due to be held before the end of May, and Labor now has a two-party preferred lead of 56 to 44%. And Michael, the Financial Review is reporting that the amount of money people have stashed away has reached $245 billion and businesses have another $179 billion in the cupboard. That's according to Treasurer Josh Frydenberg, who says there's now a war chest of private sector savings to support the economic recovery.
All right, running through some of the other stories around today, Australia has been invited by the French government to a summit in Paris for foreign ministers of European Union and Indo-Pacific countries. The invitation is obviously pretty significant given France's anger at Canberra after the Morrison government dumped the French submarine deal last year.
Michael, there was a block trade of Myer shares on Friday and market watchers believe Solomon Lew was the buyer. 3.9% of the department store's stock changed hands. Now, Mr. Lew already owns 15.8% of the company and looks to be creeping towards that 20% level. Last year, Mr. Lew unsuccessfully tried to spill the Myer board. Looks like he's still circling.
There's so much drama there. It's always exciting to watch, isn't it?
Anything Solomon Lew does is worth watching because he really does create drama, you're right.
Now, gold digger Newcrest Mining says total production jumped 10% during the December quarter and it's on track to deliver between 1,800 and 2,000 ounces of gold this financial year. The group, which in recent months has been pushing further into copper, is among the most efficient gold producers in the country, but its share price has really struggled along with the price of the precious metal. Its share price fell more than 5% on Friday and it's off 11% this year.
And Gina Rinehart's Hancock Prospecting will sponsor the Australian Olympic team after reaching a deal with the Australian Olympic Committee. It includes Winter and Summer Olympics as well as the Youth Olympics and Pacific Games. Hancock Prospecting has had a long association with Swimming Australia.
Yeah, do you remember seeing some of the ads that were produced during the Olympics last year promoting the connection between Swimming Australia and Hancock Prospecting? That was cinematic. It was huge.
They sure, I mean, you've got to give it to Gina Rinehart. She doesn't do anything by half measures.
Yeah, and I'm sure that would be very much appreciated by the athletes because obviously funding can be hard to come by for some sports.
Sure can.
Now, what's the key overseas news this morning, Sean?
Well, the UK government has ordered its armed forces to be ready for deployment across Europe as the crisis on the Russia-Ukraine border continues. Authorities from Kyiv reported new cyber attacks in the country. The US has ordered citizens out of Ukraine and officials say Russia is clearly preparing for an attack. However, the Ukrainian president said evidence of an imminent invasion was insufficient. All very difficult to read, that one. Talking about difficult to read, Italian politics has always been, shall we say, colourful. The country's Prime Minister is Mario Draghi, highly respected, a reformist and a former boss of the European Central Bank. Now, Mr. Draghi wants to become president, which is a less hands-on role, shall we say. Problem is, Italy's parliament wants him to be Prime Minister. There's been a bit of a standoff and a week of voting to find a new president. Mr. Draghi's really been caught in the middle of all this. Eventually, the incumbent, Sergio Mattarella, will stay on and Mr. Draghi will remain as Prime Minister. Just another week in Roman politics.
Hang on. So he doesn't want to be Prime Minister. He wants to be president. He's not going to get to be president and he's now being forced to stay on as Prime Minister.
Pretty much. And he's got this great reform agenda, which hopefully will help the Italian economy, which is like the fourth largest, I think, in Europe. Really needs some help with that economy. Everyone wants him to do it except for him, it seems.
God, it just makes Australian politics seem very, very dull, doesn't it?
Yeah, it sure does. In fact, I think Italy has had more prime ministers than any other country since World War II.
Well, that's saying something, because we would have to be up there, wouldn't we, in the last few years at least?
Oh, yeah. I mean, I think since we had Menzies for many, many years. So since World War II, maybe not. But in more recent years, we probably would be up there. Anyway, Michael, the Winter Olympics start at the end of the week. And China, one of the few countries following a zero-tolerance policy on Omicron, yesterday reported 16 new COVID cases among athletes and teams. I reckon the cases and how Beijing responds is going to be one of the most fascinating parts of the run-up to the competition that kicks off on the weekend and even throughout the competition. And finally, you can't say share markets aren't fickle. The big falls in tech stocks in recent weeks and months means fortunes are being wiped out. Last Thursday on Wall Street, for example, the net worth of Elon Musk, founder of Tesla, and also the world's richest person, fell by almost $26 billion. That's in one day. He's lost around $54 billion this year, according to the Bloomberg's Billionaires Index. The fortune of Mark Zuckerberg, co-founder of Meta Platforms, better known as Facebook, has dropped by about $15 billion. In fact, Warren Buffett, the legendary investor and long-time billionaire, is now richer than Mr. Zuckerberg. Of the top 10 billionaires in the US, the only one to appreciate in value this year has been Warren Buffett. That's one for the old guys.
That's fantastic. Imagine having enough money that your fortune could drop by $26 billion or $15 billion and you're still one of the richest people in the world.
It's ridiculous, isn't it?
It really is. Now, Sean, up next is the Fear and Greed Daily interview. And speaking of tech stocks, today you're speaking to Elise Kennedy from Jarden Australia about tech stocks.
Exactly. Fantastic timing. She talks about buy now, pay later groups, WiseTech Global, Seek, Xero, plenty more, whether she likes them, whether she doesn't. Definitely a good one for investors.
Yeah, absolutely. That's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And also, today actually marks the return of the week ahead with our resident economist, Stephen Koukoulas. Massive week. Great show to listen to today.
He's very excited, Stephen, because, of course, the Reserve Bank comes out tomorrow. The governor of the Reserve Bank speaking. There's plenty of data points as well. Stephen at his finest, I'd say.
I would agree with that. And I have to mention this. Yesterday was our first Sunday edition for the year. If you're looking for something a little bit lighter than your normal business news, make some time to have a listen to it. Would you agree?
Absolutely. It's good fun. Very different from the normal show. Well worth a visit.
That's right. That is also in the Fear and Greed playlist, or you can head to fearandgreed.com.au to find it. Thank you very much, Sean.
Thank you, Michael.
It's Monday, the 31st of January, 2022. Make sure you're following the podcast and, of course, join us online on LinkedIn, Twitter and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.